No. Hello? Hello?
Hello, Mayo, can you hear me?
Yeah, I can hear you. Can you hear me, sir?
Yes, I can hear you.
Okay.
Okay. So I think some more people are still trying to join. Let's give them some minutes. I think somebody has already joined. So let's give them some minutes to join us and see how it's going to be. Thank you.
Okay. Okay, sir.
But you don't go, no God. are you? That is why you are called Jehovah. That is why you are called Jehovah.
Hello, good morning, everyone. You're welcome to our monthly webinar once again. I want to appreciate you for giving out your time to join us on this webinar. And we want to please plead with you that you should just give us just 2 more minutes so that some other people can join. We are trying as much as possible because this streaming is also live on YouTube. So we are trying as much as possible to make sure that as many that can join it could join from wherever they are. So please, could you just give us 2 more minutes so that we can start the webinar in 2 minutes or 3 minutes more? More time. Thank you very much. Hello once again. Hello, good morning once again. You are welcome to Auto Steven webinar. It's our monthly webinar that we have every month. And this morning we will be talking on investing and profiting from fixed income security. We have our seasoned research analyst here with me. My own name is Olayemi David. I'm the head of operation and IT. And I also have with me that will be talking with us this morning, Olumayo Abulijoko, who's the head of team of our research, an analyst, and is also a broker. He will be talking to us this morning on investing and profiting from fixed income. Please sit tight and watch us as we expose some things to you about fixed income. Mayo, you're welcome.
Good morning, everyone. So, right about now, I'll be sharing my screen. Good morning, everyone. Might know if you can see my screen.
Yes, you can see your screen. Yeah. Go ahead.
Okay. So, I would be running you through investing in fixed income and investing and profiting from fixed income series one. So, before you start profiting from an investment, you need to really understand investment. Most people invest based on bandwagon effects because people are doing it. They go ahead to invest in that particular instrument, not really understanding the instrument. So today I would be giving you the basics about fixed income securities. Then subsequently we'll dive a little more deeper. So here's our outline for today. I would introduce you to fixed income securities. We'll talk about bonds because bonds happen to be the largest account for the largest chunk of fixed income securities. So we have the bond, we have some other instruments, and we even have structured instruments, so such as
Hello, Mayo, we cannot hear you again. Hello, Mayowa. We cannot hear you again. Hello, everyone. Please, we are still live on. Hello, we
Hello?
can hear you now.
Apologies, I had little internet issues.
Okay, and speak on now.
Okay, thank you. So I was trying to introduce what our topic is all about
Please,
today,
we
and I
appreciate
said
if you can
basically,
come over on your introduction again so that people that did not listen very well can hear you.
okay, thank you. So I said I'll be walking you through investing in and profiting from fixed income securities. Before you profit from a security or an investment, you need to even understand the investment. Like I stated earlier, so many people invest based on bandwagon effect. Somebody comes up and say, "I'll give you 30% return or 100% return," then they invest. They do not even know what they are investing in. So before you can profit, invariably you need to understand the investment you are going into, and that's what we'll be delving into this morning. So basic introduction, the our level of content is basically I've introduced the securities, talk about bonds. Bonds happen to account for a large chunk of fixed income securities. Then we talk about concepts that you might have seen in your emails on WhatsApp, where we send certain pictures, and you'll be wondering what are these pictures, what do they mean? Then I'll talk about risk, because you actually, when you're investing, you're actually taking some level of risk. So risk is inherent in every form of investment. Then finally, we talk about basic valuation, not too complex computation, basic computation basically. So we were talking about fixed income, but let me just give this background information, just for a reminder. If a person wants to start a business, or a corporate, or wants to start a business, is either they raise equity, or they raise debt. So equity basically means that the owner's fund, shareholders funds. I'm pretty sure that most people know about this source of capital. Then the other one is debt securities. This is a road less frequently traveled, because most people don't really understand what the debt market is all about. So that's what we're delving into basically this morning. So debt security arises when a person a person lends money to an individual or to a corporate organization. So a corporate organization might need money probably for expansion or going into a new project, or even for working capital, for the capital for the daily running of the business. And they do not want to issue new equity. They want to issue new shares, because basically issue new shares means could imply dilution of existing shares. So they could turn to the debt market and say, okay, we want to issue debt securities. And like most finance people will tell you that debt is cheaper than equity, because of the tax deductible argument, tax deductible advantage of debt. People usually say that debt is cheaper than equity. So a company might want to raise debt, might want to raise debt to because they do not want to dilute their current equity, the current equity, or because it is cheaper for them to raise debt. So basically, the equities market and debt market are divided into two broad categories. You have the primary market and the secondary market. The primary market is the market for where the instrument is introduced for the first time, and the secondary market is basically where instruments are now being traded. Now, turning to the fixed income security. A fixed income security is a debt investment in which an entity lends money to another entity for a fixed and periodic amount of interest as stated in the indenture. So when you are lending money to a company, they will give you something in return. They'll give you interest. They pay you interest in return for borrowing them the money, because you have assumed some level of risk. So they are compensating you for the risk you you actually assumed by paying you a fixed amount of interest. We'll get to understand later that this amount might not be fixed, it might be variable as we go on. So the the indenture is just a legal document showing the terms and offer of the loan or of the debt security. So what's the interest that will accrue to the investor, what's the maturity date, how do we compute interest, and so on and so forth. And it also contains covenants, which could be affirmative or negative covenants. So, like I said earlier, the term fixed income doesn't necessarily mean that the instrument pay fixed amount of interest. Some instruments might pay floating interest. So some instruments might be such that they don't pay a fixed amount. They have a base, a minimum amount of interest plus some other interest, like what they usually call the reference rate. So the reference rate could be the London Bank the London Interbank offer rate. It can be the NIBOR. Invariably, it means that at every point in time when the investor is due for interest payment, the interest he received previously might differ from the previous interest he has received based on the rate in the market, the reference rate. So looking at the indenture, we stated earlier that the indenture is a legal document showing the terms and conditions of the debt instrument. So some of the things you find in your indenture is you find the purpose, the interest calculation, the interest rate, maturity date, embedded option. So this embedded option is very, very important, and I would explain it a bit more. Then talk about protection period and so on and so forth. So the embedded option is called embedded because it cannot be traded in isolation to the instrument. It is part of the instrument, cannot be traded separately, just like your warrant that can be traded separately. The embedded option simply means that that particular option or that particular condition cannot that particular option cannot be traded separately from the instrument. It is part of the instrument. That's why it is being called embedded. So the embedded option can be a call option or a put option. Basically, a call option is it gives you the issuer, that's the company borrowing the loan, the company borrowing the loan or the money, the option to terminate the investment before maturity, prior maturity. And an issuer decide to terminate why would an issuer decide to terminate an investment before maturity? Probably maybe in the market the interest rate has fallen, so they will actually get a cheaper debt from the market at a lower interest rate and use it to refinance the previous debt. So they can actually raise money at a cheaper rate. So it makes sense for the issuer to call up the initial debt instrument because it's at the higher rate, and substitute it with a cheaper debt instrument which is at a lower rate. So what I'm saying variably is that the issuer will call a debt instrument when the rates in the market are falling. On the other hand, you have the put option. So this gives the right to the investor to sell back the security to the investor. So in bold here, we can see that a call option is favorable to the issuer, while a put option is favorable to the investor. So if it's favorable to the issuer, invariably you would have a higher interest rate. You have a higher interest rate being paid by the issuer because it's favorable to the issuer rather than the investor. The other one, we could have conversion option. So this option allows the debt holder to convert the debt security into equity security. And why would an investor want to convert a debt security into equity security when the market price is higher than the conversion price? So let's say, for example, you have maybe like a Zen Bank stock selling for maybe around 26 naira, and you have the option to convert at 22 naira. Of course, it makes sense for you to convert because By the time you convert 22 naira, you're in profit of about 4 naira or so. So a quick recap: an investor will convert when the price of the stock is higher than the conversion price. Moving on, we have debt instruments. So debt instruments is divided into two broad categories. Like we have the money market instruments and the capital market instruments. So money market, anytime you hear money market, basically they're talking about instruments that they trade for, that have maturity of less than a year. So you have commercial papers, you have treasury bills and the rest of them. Then you have capital market instruments. So capital market instruments are instruments that have maturity greater than 1 year. I'm just making this simplistic. Basically, instruments that are more than 1 year, which we usually refer to them as capital market instruments. So what are the characteristics of the money market instruments? So to my far right, you can see some money market instruments. You have the treasury bills, you have the commercial paper, you have bank acceptance, certificate of deposits, repurchase agreement, we have call deposit. So moving on to the characteristics of money market instruments, we have maturity. Like I said earlier, they have the maturity of less than a year, and um, some might be overnight. Next, we have financing needs. So money market instruments are basically used for short-term needs, like for example, working capital. So basically what companies do is their financing, they use appropriate financing means to match their fund needs. For example, if a company is looking at raising money for working capital, it makes sense for them to raise short-term instruments like money market instruments. But if a company is looking at investing in maybe expansion or going into a new venture, it makes sense for them to raise a long-term cap. So such a company is better off going to the debt market going to the capital market to raise money rather than raising money in the money market because they are of short-term maturity. Degree of risk. So money markets are touted to have lower risk because of the short maturity. Because the maturity is closer, they tend to have lower risk. Invariably in finance, the longer the maturity, the higher the risk. So an instrument that has a shorter maturity is believed to have a lower risk compared to an instrument that has a higher maturity. So nature of instruments. So most money market instruments are issued at a discount. So issued at a discount is they are issued less than par. We'll talk more about this later on when we're talking about bonds. Then finally, we have liquidity. So liquidity talks about how easy is it for you to convert this instrument into cash. So instruments that have high liquidity, they usually say that they usually say that they are liquid instruments because I can really convert it into cash, because some people even refer to them as near cash instruments because you can easily sell them and convert them into cash. So money market instruments are liquid instruments. The other type of instruments are instruments in the capital market. So some of them are sovereign bond, we have sukuk, we have state bond, municipal bond, like your local government bond. Then we have corporate bonds, or some climes, in some countries they refer to them as debenture. Characteristics of money market capital market instrument is just like the opposite of the money market instrument. They have maturity ranging from more than 1 year and above. The financing needs that money capital market instruments are best suited for are long-term financing. Probably a company wants to finance a project like I mentioned earlier, or maybe they want to do some expansion. Next, we have degree of risk. Like I said earlier, in finance, usually say that an instrument that has a longer maturity has a higher risk. So invariably, capital market instruments have a higher risk when compared to money market instruments. Then the nature of issuance could be at par, at discount, or at a premium. We'll talk more about this when we are talking about bond. Then liquidity. So most capital markets are illiquid. That means they do not they trade in the team market. That means they are not frequently traded. The more a security is being traded, the more liquid the security is. So if you see a security that is less traded, then if you see a security that is less traded, we can safely conclude that this security is less liquid. So underneath, I just have a little caption here. So there are some instruments, some capital market instruments that do not even have a maturity. For example, in the United Kingdom, government issued consoles. Console is a type of a bond that doesn't have maturity. It doesn't have the date of maturity. Then we have some bonds can be centenary bonds. That's bonds that have 100 years maturity. Like for example, Argentina issued 100 years an 100 years bond in 2017, while Mexico did the same in 2010. So these are some of the participants in money market and capital market. This list is not exhaustive. What I'm saying is that the list could be is bigger than this, larger than this. These are just a few participants in both markets. So the money market, we have central bank, commercial banks, investment or merchant bank, insurance companies, corporate entities, pension funds, discount houses, then individuals through money market funds. People who do not have enough funds to participate in the money market can go through money market funds. Then capital markets, we have the Securities and Exchange Commission. Okay, that's a regulator. We have we have the Nigerian Exchange Limited, what was formerly known as the NSC. This is a self-regulatory organization. So self-regulatory organization simply means that they are organization that just regulate their members only. They don't regulate people outside their membership. So, for example, this SEC regulates the investment industry. So that's a major regulator. Why the NSC is a self-regulatory organization? Because it regulates the activities of its members only. So FMDQ is another self-regulatory organization. Then we have stockbrokers, trustees, issuing houses, registrars. We have institutional investors, retail investors, and so on and so on and so forth. Like I said earlier, this list is not an exhaustive list. So we're going to be talking a little bit about bonds. So a bond is a fixed income instrument that represents a loan made by an investor to a borrower, usually a corporate, government, supernatural organization, or sponsored government institution. So what we are saying basically is that you are giving out a loan to to a corporate, for example, maybe Zenith Bank, or the government, federal government of Nigeria. Supernatural organizations are big organizations, international organizations, just like your IMF, your World Bank, your AFDB. Then you have sponsored government institutions, maybe government agencies want to raise money from the market. So basically, we usually have generic names for some of these instruments. So generic name is just like a general name for the instrument. So if somebody is talking about a federal government bond now, basically what the person is talking about is a sovereign bond. So if you don't want to be too specific, you probably don't want to just limit yourself to maybe Nigeria, you can just say sovereign bond. So anywhere you mention a sovereign bond, basically people understand that is the bond issued by the federal government or the central government of a country. Then you have state bonds, we call them non-sovereign bonds. You have local government bonds, we call them municipal bonds, that's the generic name. Then we have corporate entity. For corporate entity, we call them corporate bond or debenture. Then international organizations such as the World Bank call it supranatural bond. So moving on, we'll be talking about the bond indenture. We already introduced the bond indenture before. We said that it is a document that shows the terms and conditions of the offer. So some important points you might need to note about an indenture is it's usually a very a very voluminous, usually voluminous, like it could run into hundreds of pages. Then is so as a way of advice, you can start with a very hello, hello, can you hear me?
Hello.
Hello. Hello, please, can someone confirm if you can hear me?
Mayowa, are you still there? Hello, Mayowa.
Hello, I can hear
Mayowa,
you.
please, we
Can you
cannot
hear
hear
me?
you.
I can hear you.
Yes, can. Okay, okay. So, might I know where the internet dropped off?
Okay, yes, we can hear you now.
Okay.
No, no, no,
I
it's
don't know
okay
where
now. You can talk now.
where I stopped before the internet dropped off. Hello? Hello?
Hello, Mayowa. It's cracking now.
Can you hear me?
Yeah, we can hear you. You stop on
Can you hear me?
the voluminous nature of the
Can I
bond indenture.
continue from here? Okay, so okay, that means we're on the same page. Thank you, sir. So, like I stated earlier, before the internet dropped off, the definition of the bond offer, and I said that it can run into hundreds of pages, and because it can run into hundreds of pages, you can you need to you might need to consult your stockbroker or other financial advisors for guidance, and in order to ensure the performance of the bond indenture, we have a trustee, which is usually appointed to protect the interest of the bond holder. So some trustees in Nigeria are called Cordros, Meristem, Cardinal Stone. So a trustee is basically an organization or a firm that is appointed to ensure the performance of the bond contract, and they have fiduciary duty, a duty of trust. That's why I usually refer to them as a trustee. So they are appointed on behalf of the debt holders, the bond holders, to ensure the performance of the contract. So like I mentioned earlier, we said that the the indenture can run into hundreds of pages, but as a way of summarizing the indenture, there's something called the indicative offer, and I'm sure most people who receive our emails and receive our WhatsApp messages would have seen most people who receive our emails and most people who receive our emails and our WhatsApp chat and our WhatsApp messages would have seen pictures like this pop up on the group or in their email. So this is an indicative offer. It's just a way of summarizing the terms and conditions of the offer at a glance. So instead of you reading through the hundreds of pages, you could actually a bond offer. So this is an offer that was launched recently. I think it's closed already. So this is for Lagos Free Zone Company funding SPV. So SPV is just a special purpose vehicle. That's that's a whole topic on its own. But let's focus on the indicative offer. So when a person sees the indicative offer, so you have a sponsor, then you have the issuing house, the guarantor, the program size. So $25 billion of the total borrowing, the programs of the total program size. And you can see here they are telling you that it's series two. So out of this program size, the company has issued a series one before, and they're now issuing a series two. So what this is just trying to tell you is that out of the 50 billion program size, the company has issued one before, and they're issuing a second one, and they are saying that the size of this second one is up to 25 billion. So that's the size of this issue. So next is the type of description of the security. So security could be secured or unsecured. For this one, it is secured, the secured security. Next is the issuer rating. So we have organizations that we call issuing rating houses. So they look at the credit worthiness of the company, and they give the company ratings. For example, this particular offer has a BBB minus from August 2, and another company the issuer is rated BBB minus from August 2, but the issue itself is rated AA. So AA invariably means that the company is credit worthy. It has a good credit it has a good credit history, or it has a good credit standing. The next one is the book build guidance. So this offer is basically book build. So book build basically is open to institutional investors or high net worth individual. It's not usually open to the public. So the next
Hello, Maiwa. Can you hear me? Yeah, you see me, I'm not hearing you again. Can you hear me? Hello? Hello, everyone. This we are trying to round up this webinar so that Maiwa can be able to this Maiwa kindly. Okay, Maiwa, you can continue.
Please, can you confirm you can see my screen? Please, can you confirm if you can see my screen? Okay, so the last where I stopped was the redemption basis. So this particular bond has a moratorium period. So the moratorium period is 60 months moratorium period. So they won't pay principal, they won't start repaying the principal until after 60 months. We'll talk more about this redemption later on. We'll talk more about redemption later on. So we have payment date. This is an important concept here, short coupon. So short coupon basically is a prorated coupon because the issue is not going to be like the 6 months interval. This is a semi-annual, but so it's supposed to be 6 months. But if you count from the day of issue to the day the first coupon will be paid, it's not up to 6 months. So they count the number of days that's left divided by the total number of days, that's 180 days in every 6 months, times the coupon. That's the amount that this debt investor will receive. They have call options. So some people see the rate on a bond and they begin to jubilate that the rate is high, the rate is high. These are some areas you need to pay attention to. So this bond has a call option. So after 5 years, the issuer is allowed to call the bond. Like we said earlier, if the market interest rate has fallen, the issuer can decide to pay off the bond before maturity, and this disrupts debt the investors cash flow because they've already anticipated a particular cash flow for a particular period, and now the cash flow is being shortened. So now the investor would have to look for another investment like that is related or similar to that, and that might be difficult because the interest rate might have fallen. So investors need to pay attention to this option, this embedded option, call option, to see if they really have an appetite for it or not. So let me just keep okay call price. So call price is basically the amount the amount that it will be called. So if this issuer decides to call this bond in between 5 and 10 years, then they will be calling it at a premium. That's 101%. We will explain this concept Apologies, please. Okay, so let me quickly recap what I've said here so far. We talked about the call price. The call price is basically the amount that the issuer wants to call the bond. So if you're calling it between 5 to 10 years, it will be called at a premium because it's higher than par, it's higher than 100%. If it is between 11 and 15 years, it will be called at a premium. That because it's higher than 100. Then if it is between 16 to 20 years, it will be called a at par. We call that par. So listing basically two exchanges, Nigerian Exchange Limited and FMDQ. Then the use of proceeds is very, very important for us to understand what the company wants to use this money for. So this company wants to use it to refinance existing credit facilities. Like I said earlier, if a company feels that the current market interest rate is low, they can decide to raise money at the can decide to raise debt at the current low interest rate, and you need to repay the previous interest rate, the previous loan they have, which was issued at the higher interest rate. So they are basically refinancing by borrowing at a lower rate, and you need to pay the previous debt they have, which is at a higher rate. And of course, they said they want to use another part of it to for capital expenditure. Okay, so this is another company. This is Dangote. So yeah, their own borrowing size is 300 billion, and the issue size for this is 50 billion. Then here, then here it is divided into different maturities. They have different tranches. So this is called time tranching. Time tranching basically is that you have a whole bond issue, but you now divided it into different maturity period. So you have a tranche for 5 years, tranche for 7 years, tranche for 10 years, and this bond too is also callable. Now, if you look at this, they are saying that this bond can be called partially or wholly. So they can either call part of the bond or they can decide to call all of the bond. Let's moving on quickly. This is price range, par value. We'll talk more about par value. Then let's just talk about the redemption. So the redemption is bullet repayment. So bullet repayment simply means that the principal will come at the end of maturity. At maturity, that's when the principal will come back. They will pay you in your interest will be paid as at when due, but the principal will come at maturity. And that's what most bond issuers do. They usually pay the principal at maturity, except for a few ones which usually amortize. Like the previous one we looked at the previous one is repaying the loan, is going to repay the bond using amortization. They are going to amortize the bond. They are not going to pay the whole of the principal at maturity. We'll get to understand this more in a subsequent slide. So the use of this proceeds is basically for financing existing short-term debt and general corporate purposes. So moving on, we have different types of bonds. I'll quickly run through these. We have zero coupon bond. Zero coupon bond is a bond that does not pay coupon. So what is usually issued at a discount. So what the interest the investor receives, the tentative interest the investor receives is the difference between the par value and the actual amount paid for the bond. So let's take for example a bond is issued at 95%. So there's a 5% difference. So the 5% difference accounts for the interest. The interest is actually not the. Let's just say that the interest or what the benefit that accrues to the investor. So fixed coupon bond we already stated that a bond that pays a specific amount of coupon at a specific period of time. Then we have a floating bond. A floating bond is it pays a base interest plus reference rates plus the reference rate. So the reference rate, like we said earlier, can be NIBOR. Then we also have the index linked rate. So one of the major cons of fixed income securities is is that the real if inflation increases, the real returns reduces. So you will still receive your nominal value, but the purchasing power, of that value you are receiving has been washed away. Part of it has been washed away as a result of inflation, rising prices. So in order to mitigate this rising the inflation risk of on the bond, there are some instruments that are called index linked bond. So these bonds are usually linked to an index, for example, the inflation. So we have a good example of this is the Treasury inflation protected securities issued by the United States, or real return bond in Canada. So basically, they are trying to compensate the investor for inflation risk. We'll talk about inflation risk in a subsequent slide. So we have other types of bond. We have global bond. So a bond that is issued in several countries at the same time, that's a global bond. You have euro bond. So euro bond is a bond issued in in, in a currency other than the currency of the currency of the country or market which it is issued. So for example, it if I decide to issue a bond in the United Kingdom in dollars, obviously the currency of the United Kingdom is the Great Britain pounds, and I'm now issuing it in another currency, the United States dollar. So that kind of bond is called an a euro bond. It's called a euro bond. The next one is a foreign bond. So euro bond and foreign bond, they usually people usually mix them up because they have some level of similarities. But the major difference is that the foreign bond now is issued in the domestic currency of the market, in the domestic currency of the country it is being issued. For example, if I decide to issue a bond in the United States, if I'm a Nigerian company, I decide to issue a bond in the United States, and it's being issued is denominated in the United States dollars, it is a foreign bond. If you look at it closely with the euro bond, now I'm issuing it in the current I'm issuing it in a currency other than the currency of that particular country. That's euro bond. Foreign bond, I'm issuing it in the currency of that country. That is a foreign bond. So we have deferred bond. So this kind of bond defers payments. It defers payment to a particular period before it is being made, and the principal comes at maturity. Then you have the accrual bond. So it defers interest till maturity. That's the accrual bond. So, like I said earlier, we'll talk about how will companies repay these bonds. So, a bond can be fully amortized. A bond can be fully amortized. So, fully amortized bonds is the company pays part the interest and part of the principal at every point in time. So, if they are supposed to pay year one, they will retire a portion of the principal and also make the interest payment. That's a fully amortized bond repayment in such a way that at the last payment there will be zero principal remaining for them to pay. That is a fully amortized bond. A partially amortized bond is closely related to a fully amortized bond, but in this situation, a particular portion of the loan is kept till maturity, and it is being paid. Let me just give a very simplistic example. Let's say that I have a bond of worth 100,000 to repay, and I want to use the partially amortized repayment mode. The, at every point in time, I'll pay part of the principal and interest, but the portion of the principal that I will leave till maturity. Let's say, for example, I want to leave 20% of the principal till maturity. I would now have to start at every point in time when I'm making payments, except the final payment. I'll be retiring the 80%, that's 80,000. So at maturity, and pay, of course, obviously pay my interest. So that is a partially amortized loan. But a fully amortized loan, I will pay the principal and interest, the portion of the principal and I will also pay the interest. That at the final mature, at the final payment, my principal will be zero. It will be zero. Partially amortized, a portion of the principal will be kept to maturity, till maturity. So the last one is the bullet repayment. I'm sure we already stated this when we were talking about Dangote bond. So bullet repayment simply means that the principal comes at maturity. Principal comes at maturity. So at maturity, let's say the 100,000, like the example I stated earlier, the 100,000, I'll keep paying the principal, the interest. Let's say the interest is let's say the interest is 10%. let's let's say the interest is 10%. So at every point in time, I'll be paying 10,000 as interest. That's my coupon. I'll be paying my coupon 10,000 at every point in time. But I'll not pay any part of the principal at all until maturity. When it is maturity, the last year when the bond will mature, I'll now pay I'll pay the principal and the interest I've been paying regularly. That is a bullet repayment. So let's move on to other concepts very quickly before we round off. We round off. So coupon, like I've always been saying, coupon is basically the interest that is paid on the bond. That's the interest, and it's paid at a specific period of time. Like I said earlier, it might not be fixed. It might be floating. So a bond might have a fixed coupon, let's say 5%, semi-annual. So at every point in time, you will always receive that. A bond can be floating. It might be 5% plus a reference rate. So, but basically, the coupon is the interest that is the bondholder is entitled to. So you have the yield to maturity. So the yield to maturity is basically telling us what the return that the investor is expected to have earned if he decides to hold the bond to maturity. This would I'll just leave it there for now, because this is a broad topic area on its own. Next is next is the nominal value. So the nominal value is basically the face value. So a bond can be on 1,000. That's the units, might be 1,000. It might be 100 units. So for every one bond, the equivalent nominal value is 100. So 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 if you have a unit of a bond, the equivalent is 1,000. So 1 unit of a bond costs you 1,000. So denomination. So the bond can be issued at par. It can be issued at premium, and it can be issued at a discount. So if you are saying it's issued at par, the issuer receives the face value. So if I say I have um a 1,000 naira per unit bond, so the issuer receives 1,000 naira. So if I said I have a premium bond, so the issuer receives above the par value. And if I say I have a discount bond, the issuer receives below the par value. So usually being quoted in percentage terms. And if you have a bond that is at 100%, you say that it is issued at par. If you have a bond that is 98% or 92%, less than 100, basically it is issued at a discount. And if you have a bond that is above 100, it's issued at a premium. So you have bond codes. So basically, like we said earlier, we said that capital market instruments are not frequently traded, and by implication, they are less liquid. So the way capital market the way bonds are being traded, basically they are quote driven. So market participants usually quote a bond and ask price, a bond and ask price. So the bid price, sorry, a bid is not a bond, sorry, it is a bid price and ask price. So the bid price is the price in which the bond is being offered or to be bought. Is being offered to be bought, while the ask price is the price in which the bond is being offered to be sold. So the amount that the seller is actually wants you to pay. is the ask price. The amount that the buyer actually wants you to buy the bond is the bid price, is the um so the amount that the buyer wants to is proposing to buy the bond is the bid price. Then in between that, the difference between the bid price and the ask price is called the bid ask spread. It's called the bid ask spread. So this is just a typical bond quote. So this is for FGM bond. This for FGM bond. This is um, a typical bond quote. So if somebody wants to purchase, if somebody wants if this particular market participant is actually requesting um March April 2023 maturity FGM bond, is actually requesting it to be bought at 106. So he's actually requesting a premium for this, and is actually um so sorry, this particular market participant wants to buy this at this amount, that's 106.08, and he actually wants to sell at 108.008. So this is the equivalent yield. So you usually quote based on price or yield. Would understand this a little bit better in the next in a subsequent slide. So, like I said earlier, risk, if you are embarking on any investment, risk is inherent. And here's the definition, a simple definition of risk. Risk is the chance that an outcome or investment actual gain will differ from expected outcome or return. So if your expectation is that, okay, at so point I'll always receive interest payments, and let's say for example the company who has issued that has issued the bond begins to face some challenges and they're not able to meet up their bond obligation. That's risk. There's a possibility that some companies, some investment might not pay in the cash flow as at when due. So that's risk. And here is a picture of Warren Buffett, one of the top investors in the world. So we can see a little graph here. It's telling you that the more risk you take, the greater the return. So the higher the risk, the higher the return. So, but we always advise you take calculated risk. You don't just take risk indiscriminately without you looking at your risk appetite and some other considerations. So looking at the borrower, what are some of the things that you need to even look at the borrower? You need to some of the things you need to assess when you are looking at the borrower. So you look at conditions. Okay, what's the interest rate and the maturity, the character, the credit history. So like individuals, if you borrow money frequently, your whichever organization you are borrowing money for, they have your credit history. They submit it with the credit bureau. So at every point in time, you go to one, if a person defaults and goes to another company, right there they will be able to generate the person's credit history and see if the person is credit worthy or not. So character basically talks to the credit history of the client. So collateral, okay, in case there's a default, how can I recover my money? So collateral is important. And of course, if you have a collateral bigger than the value of the loan, it is better, because you are sure that if there's a default, you can actually fall back on the collateral for to recover your investment. So you have capital. Also, the amount needed is important. The amount needed is important. Someone that probably a company that the revenue side is not too good and is asking for something way above his revenue, obviously a case that you need to take a second look at. You need to take a second look at it, because how would they even repay such loans? The next one is the capacity. So how well can the company meet its debt obligations? So in fixed income securities, here are some of the risks that are inherent. You have the interest rate risk, like I've been mentioning earlier. If the interest rate changes, what happens? So what you need to note is that the relationship between the bond value and the interest rate is inverse. So if interest rate is going up, the bond value will, the price of the bond will fall. And there are two types of interest rate risk: the price risk and the reinvestment risk. So the price risk is the risk that concerns that concerns the recoverable value of the bond when we decide to sell, because interest rate has changed. Then reinvestment risk is okay, because interest rate has changed. At what amount will I be able to reinvest my coupon? Will I be able to invest my coupon? That is the reinvestment risk. So if the investment has fallen, that means you have to reinvest your coupon at a lower rate compared to the previous risk you've been investing the coupon before. That's the reinvestment risk. So core risk or prepayment risk, like we said earlier, the 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 issuer can decide to shorten the life of the bond by calling it before maturity. That's core risk. We talk about credit risk. The risk that the counterparty, so the issuer, basically does not fulfill its obligation. We have inflation risk. Inflation risk is the risk inherent in the fact that the value of the value of your return is being reduced. The real value of your return is being reduced because prices are rising. Prices are rising. That's inflation risk. And we said earlier that we have credit linked instruments. So credit linked instruments usually try to protect investors against this inflation risk. Then you have liquidity risk, the risk that inherent in the fact that you're not able to convert your your investment, your bond into cash very quickly. Exchange rate risks. Okay, so if it is if the bond is being issued in a different currency rather than your own currency, if there's depreciation or appreciation of the value, it actually affects the actual returns that accrues to the investor. Then event risks, something unforeseen happens to the company. So that's event risk. So if something unforeseen happens to the company, of course it will affect the payment of the servicing of the loan, and the servicing of the loan, or the repayment of the uh, debt instrument. So here's a whole lot of work for you to do, from credit analysis to type of risk. So there are some organizations that specialize in looking at the credit worthiness of the organization, and you have a few of them on this slide. You have Moody's, you have S&P, you have Fitch, and in Nigeria you have Agosto and Co, Data Pro Limited, Global, and the credit rating. So here's just Moody's investment grade. So anyone that is AA, triple A to BBA3, they are referred to as investment grade. So they are collectively called low risk bond. Although each category has different level of risk, but generally they are being referred to as low risk bond. And if it's a low risk bond, then the interest will be low because the risk is low. But the other type of categories are the speculative grades. Those are high risk bonds, or they call them junk bonds or high yield bonds. So here is Moody's classification of some bond investments. So at anytime a company wants to issue a bond, they usually look at the bond. It's very good for you to look at the credit rating of the bond, and at times the bond might even be downgraded in the course of the bond might even be downgraded in the course of during the period under consideration. It might be downgraded. Probably the credit worthiness of the company has fallen, or it has even improved. So here's just basic valuation. So here is talking about the price. We already said earlier that the price of the bond is inversely related to the yield on the bond. So if a bond has a higher yield, then of course the price will be lower. So this is just a basic formula, but we do not need to compute this basically using writing out the formulas. You can always use a spreadsheet or a financial calculator to get this. So that so some of the ways you do calculation is one of the major ways you look at what your bond investment has returned is your current yield, and current yield is basically your coupon divided by the current price. So if a bond is 10%, if a bond is 10%, if a bond has a coupon of 10%, so the bond will actually pay an annual coupon rate of 10 naira, and the current price is on 110. So the current price is the price you decide to enter. So if you enter at 110, you take 110 divided by 100, 10 divided by 110, your current yield is 9%. So this bond has actually returned 9%. So like I said earlier, this is just a basic introduction. We will delve a bit more deeper in subsequent webinars. Thank you for listening.
Yeah, thank you, Mayowa. That was a wonderful presentation. And we know that some of our viewers are on the YouTube, they might not be able to ask questions, but they can send their question online so that we can pick it from the YouTube. But those that are here, please, you can have a question, please ask your question. Please, we give room for anybody that wants to ask a question now. Manuel, that was a very good job. Any question, please? Please, let's monitor the YouTube so that we'll be able to pick up the questions. Any questions? Okay. Okay, in the absence of no question, we want to appreciate everyone for joining this webinar, and we will meet you next month again, whereby we talk about Assam e-trade. I know that many people have been using our Assam e-trade, and it has been a wonderful experience for some of our clients. That there are some clients that I've never met before, and they are doing a lot of transactions, both buying and selling. They are, what will I call them? They are broker in their own. You want to be a broker on your own, you want to be a broker of yourself, please contact us in Dr. Steven, wherever you are, abroad, Nigeria, in the village, in the city, you can trade anywhere you are, in as much as you have internet access. You can trade anywhere you are. So contact us, Dr. Steven. Our website is www.stevenonline.com. Register today so that you can start your trading experience. Thank you very much. God bless you as you have joined us today. Thank you. Like somebody asked if we can send a slide there, so we send the slide online to everybody very soon. Thank you. Bye.